And welcome back, my LLs, my Lubari listeners, my fellow real estate enthusiasts, and fellow real estate investors. Welcome back to the Lubari Real Estate Podcast, where we talk multifamily strategy, disciplined execution, and building assets that work harder than you do. Now, let me ask you something real quick. How many multifamily investors do you know whose entire market research process is, oh, the broker said the rents are going up? Well, that's not research. That's hope with a rent roll attached. Today's episode is about high-level market research, specifically for multifamily investors, the kind of research that helps you choose the right cities, avoid overbuilt submarkets, protect downside risk, and position your portfolio for long-term rent growth and asset durability. Now, this episode is going to inspire you, educate you, and challenge you. Because in multifamily, you don't just buy buildings, you buy a business. You buy renters, jobs, and economic momentum. And the best part? Everything I'm about to share with you is free 99. That's right, completely free. So, without further ado, let's get into it. Okay, so let's talk about what high-level market research means in multifamily. So, high-level market research for multifamily it is not about chasing the cap rate. It's about understanding whether rent growth is sustainable, occupancy is defensible, and demand will exist through multiple cycles. So when you buy a multifamily asset, you're underwriting household information, workforce stability, income to rent ratios, and new supply risk. Because if people can't afford rent or if jobs disappear, your pro forma becomes a fiction novel. And strong multifamily markets are built on the most boring of all fundamentals: jobs, population, wage growth, housing shortages, and things like that, because this is where the real money is made. All right, so with that being said, here's the mindset shift that separates amateurs from operators. Most investors ask, does this deal cash flow? Experienced multifamily investors will ask, does this market support long-term rent growth and operational stability? Because we all know you can force appreciation, but you cannot force demand. So you should be asking, are renters moving into this market? What percentage of households rent versus own? Are wages growing faster than rents? How much new supply is coming online? And if your only edge is buying cheap, then you don't really have an edge. So let's go over some common mistakes. Okay, so let's clean this all up. Mistake number 1, chasing cap rates instead of demand. So high cap rates often come with high turnover, low income growth, and management headaches. So don't just chase the cash flow. Chase what makes the deal stable, which is the market. Mistake number 2, ignoring supply pipelines. You can have demand today and be crushed by 5,000 new units tomorrow. So keep track of all the new assets that are being built in the area. How many new units and new properties are coming online within the next 5 to 10 years? Mistake number 3, assuming past rent growth equals future rent growth. Let me tell you the truth here. Markets evolve and cycles shift, so your data must be current. At the end of the day, multifamily is forgiving, but only to disciplined operators. So now let's look at some tools, specifically how to evaluate multifamily demand, rent growth, and supply risk. All right, so first off, we have the national economic and demographic data. So we can start with the US Census and American Community Survey. All right, this survey will give you information on population growth, household size, rent versus own ratios, and median household income. This tells you if renters actually exist and if they can pay. Next, the Bureau of Labor Statistics. Now, this will give you information on job growth in the industry or by industry, wage trends, and employment stability, because jobs pay rent. And then we have the Federal Reserve Economic Data, or FRED. Great guy. Now, Fred will give you information on inflation, interest rates, and economic cycles. Now, this can help you time leverage and stress test your assumptions. Okay, so now we're going to move on to like more so into the single family housing, because we want to know who's buying and who's renting. The more people that are buying houses, the less people that are renting. The more people that are renting, the less people are buying houses. And if more people are renting, that is good for your apartment business. Okay, so you can check on websites like Zillow Research. Okay, use it to track rent growth trends, vacancy shifts, and market cooling or acceleration. You can also look at Redfin Data Center. This is great for pricing pressure, market velocity, and buyer sentiment, which affects renters. And then HUD data, extremely valuable for multifamily. So this gives you a look at affordable housing gaps, subsidized housing concentration, and long-term rental demand indicators. Okay, so moving on to local supply and development intelligence. This is where multifamily investors win. Okay, so check city planning and zoning departments, building permits, and new multifamily construction pipelines. Because if 3,000 Class A units are coming online and your asset is Class B, you better understand who your renter is. Okay? Because supply kills rent growth faster than recessions. Because if you're investing in, or you are already invested in, a Class B, and four brand spanking new Class A assets pop up within a 3 and 5 mile radiuses, that could possibly kill your rents. It could possibly kill your occupancy, because why would someone stay here when they can go live in the best, shiniest thing that was brand new? They won't have any issues. The rent may be a little higher, but they'll have everything that they want. So be careful, and you have to think about these things. Which brings me into migration, risk, and livability, because renters care about this. So you want to look at your population estimates, your inbound migration, how many people are moving into the market, the quality of the schools, the crime trends, and also flood and insurance risk, because renters vote with their feet and vacancy is very expensive. All right, now let's talk about how to analyze a multifamily market. And here's a simple framework, step by step. Step number 1, define your asset strategy. So are you going to go looking for workforce housing, value add, or a long-term hold? Step number 2, demand. Look at your population growth. Look at your renter household growth and look at income to rent ratios. Step number 3, supply. Look at units under construction. Look at permit trends and look at the class of the incoming products. Step number 4, economic strength. Does that market have job diversity? Are the wages growing in that market? Look at the wage growth. And then also the employer concentration risk. And then finally, step 5, risk and resilience. Look at your insurance exposure. Look at your regulatory environment and look at your rent control trajectory. And if the story doesn't make sense, then don't force the deal. Never force the deal. If it doesn't align, you got to drop it. We don't get emotionally attached. Okay, now here's some market examples. So in a strong market, you're going to see things like a growing population, wage growth above rent growth, limited new supply, and diverse employment base. On the flip side, on the other side of the coin, here's a risky market example. You have a flat population. It's not moving. Nothing's decreasing. Nothing's increasing. A heavy Class A construction. Class A is beautiful, but it can be risky. Just as Grant Cardone always says, when cranes are in the air, beware. Also, rent growth driven by speculation. We want actual rent growth, not speculated rent growth. And then concentrated job sectors. You want a melting pot of strong employers and strong industries. Because if you have, let's just say, 1 or 2 major employers in the area, and one of those companies fails or moves, now you have an entire market or economy that has lost jobs. And that's something that you don't want because people are going to chase their jobs. They're going to chase the money. And that's bad for business. Now, with these examples, one survives cycles. The other gets wiped out when capitals tighten. When capital tightens. Some problems with my S's today. Okay. Now, professional operators, here's an example of how their research workflow goes. Okay. So weekly, they monitor rents, they monitor vacancies, and they monitor their supply headlines. On a monthly timeline, they review the market stats. And then quarterly, they re-underwrite their assumptions. No emotions, no attachment, just pure execution. All right. Now, here's your challenge as a multifamily investor. Pick one market you're underwriting. Pull data from 5 different sources mentioned today, all free, and then answer one question honestly. Will renters still want to live here 10 years from now? If the answer isn't clear, keep researching. And now we move on to my favorite part of the podcast where we talk about what real estate can do for you. And over the past week, I am going to have to say that peace. Peace. I got a lot of peace and mental clarity over the past week. I just got time to be by myself and enjoy my solitude. A lot of friends were asking me out to brunch or asking me to go to the casino, and this week I just wasn't feeling it. I said, "You know what? I could go, but I think I'll just stay at the house and take care of myself." And sometimes that's okay. It's okay to press the reset button. It's okay to do something good for yourself or not want to be around people. But anyway, that's my quick little tangent. But in closing, multifamily wealth is built by investors who buy strong markets. Also, they respect the cycles and they never skip the fundamentals because a deal is temporary, but a market is permanent. Unless it were to be destroyed by an asteroid or, nuclear bomb. I don't know. So if this episode sharpened your thinking, share it with serious investors, not a dreamer. And until next time, stay disciplined, stay patient, and keep building assets that last. I love you all and be blessed.